Good morning. We will pay attention to matching of assets, liabilities, equity, expenses, income. You have to match the correct column 2 answer with column 1. Current assets. What is a current asset? It's an asset that will changes on a regular basis within 12 months in the future. That could be bank, cash float, petty cash, inventory, and debtors. So if we look at this list, we have to look and see for one of those that I've just mentioned, and the only one that's available here is bank. So the one that will go with current assets will be the bank. Income increases the profits of the business. So we have to go through the list in column 2 and see if we see any income there. That could be sales, rent income, interest income, discount received. And we see that there's discount received. So for income, we will indicate that the only one in the list available is discount received. Owner's equity is the amount of money that the business owes the owner, or the total amount that the owner invested in the business, and the owner's accounts consist of capital and drawings. If we look at column 2, the only one available is capital, so owner's equity we will match with capital. Fixed assets are assets that we will use over a long period, more than 12 months in the future. That is land and buildings, furniture, equipment, machinery, and vehicles. So the only one that's on this list is equipment, and we will match the fixed assets with equipment. Expenses are things that will reduce your profits. So expenses can consist of cost of sales, stationery, telephone, water and lights, salaries, advertising. The only one in the list that's an expense is stationery, so we will match expenses with stationery. Financial assets is non-current assets when you invest money in another company, buying shares in another company, or when you invest money in the bank as a fixed deposit. So fixed deposits will be matched with financial assets. Liabilities are responsibilities of the business that will lead to an outflow of money in the future. So liabilities can consist of non-current liabilities that you will pay back in a period longer than 12 months in the future, and that will be loans and mortgage loans. Or it can be current liabilities where you owe money for goods purchased on credit. So creditors and a bank overdraft will be a current liability. And we will match liabilities with creditors. It is very important to know what assets, liabilities, equity is. So assets consist of non-current assets that you will use for more than 12 months in the future, and that could be fixed assets or it can be financial assets. Current assets is for a shorter period than 12 months in the future, and that could be inventory, debtors, bank, cash float, or petty cash. Liabilities consist of non-current liabilities that you will use for more than 12 months in the future, and that is a mortgage, bond, and a loan, or a current liability that will change every day or weekly. For instance, when you buy goods on credit or you pay your creditors, and when you have a bank overdraft. Equity consists of the following: capital and drawings. So the owner will provide capital for the business and it will be recorded in his capital account. If he takes goods or money from the business, it will be recorded in the drawings account. Income increases the profit of the business, and income is sales, rent, interest, commission. And if the profit increases, the owner will receive a bigger profit, so the equity will increase. Expenses decreases the profit. For example, cost of sales, telephone, rent, station, electricity. And if you pay expense, the profit decreases, so the equity will decrease.